Good afternoon, everyone, and good afternoon to you, Matt. Thank you for joining us today. I'll do the official introductions in just a moment, but I want to say thank you, everyone, for taking time out of your schedules to be here and learn a little bit about options. As I said earlier, we have a guest speaker, Mat Cashman. We'll pass the microphone over to him in just a moment. I just have to, do the introductions and the disclosures. My name is Jesus Nava, Director of Client Training and Education for TradeStation Securities. For us, it's always great to plan these types of sessions where we try to provide you education around options. Today's topic is all around synthetic strategies. A lot of times we hear all these names about option strategies, and we don't really understand what they are. Like, for example, synthetic strategies, I didn't know was a thing, but it's great to learn that you can approach the market using these synthetic strategies. And Matt is going to do his presentation in just a moment to tell us all about how to place them in the market, what are they, and how we should be aware of the risks around these strategies as well. Before I pass the microphone over to him, these are the disclosures. Keep in mind that every symbol and idea that we talk about is for educational purposes. These are not recommendations of TradeStation. Also, that active trading is not suitable for everyone, especially when it comes to trading options, which carry a high degree of risk. We all need to be aware of that. And all examples, of course, are that. Examples are not recommendations of TradeStation. One thing that I wanted to point out is that we are very glad to have Mat Cashman with us. He's not affiliated with TradeStation. He's with the OCC and the OIC, and he's going to go into a little bit of detail about what those institutions are. But thank you for being here. If you need more information about our risk disclosures, just go to the link right there on the PowerPoint slide, tradestation.com/important-information. And one thing that I wanted to point out before I leave the floor to Matt is that I wanted to make sure that everyone is aware of the Options Education Center inside of tradestation.com. We have several of Matt's presentations recorded and available here in the Options Education Center. So if you haven't been to the TradeStations, to this site, I just want to encourage everyone to come here and explore. I'm going to make sure that I share the link here in the chat so that everyone has access to it. But we have articles, we have TradeStation workspaces, we have PDFs, custom studies, and of course, great webinar recordings like this one, which is going to be recorded and posted here in a few days once we go through production and compliance. All right. Okay, I'm going to stop my share and mute my microphone in a minute, but I just want to say, Matt, thank you for being here with us, and the floor is all yours.
Absolutely. Thank you very much. I'm sharing my screen now, which should give you some graphics on what I'm going to present today. Jesus, thanks a lot for the introduction. Hello, everyone. Thanks for joining us today for the TradeStation and OIC webinar on synthetic strategies. The goal of this presentation is to give you a solid understanding of how these slightly more complex option spreads work, build on some of the knowledge that we've talked about previously in previous webinars, and help you with some of the nuanced risks and opportunities that these slightly more complex spreads include so that you can potentially put this to work, put this knowledge to work in how you trade and make more informed option trading decisions. Now, synthetic strategies are interesting substitutions for directional exposure. So directional exposure is what I usually talk about as far as things like stock positions, underlying stock positions. This gives you an idea of how you might create a synthetic strategy that's going to leverage the inherent leverage that exists within options that doesn't exist in a straight delta position that you might create by just buying or selling stock. The more you understand about these risks and benefits and the risk dynamics that exist here, the more you're going to be able to translate that into understanding why these spreads might be priced the way that they are and why they might move the way that they do. Again, options are incredibly dynamic. They're diverse and flexible, but they also involve leverage. And so you need to understand how that leverage works, before you start to utilize them in your investing. My name is Mat Cashman. I am the principal of investor education at OCC, as well as an options industry council instructor. I'm going to give you a little bit, very quick background on myself. I got started in the business trading options probably about 1998. I've been an options trader ever since. I got my start in Chicago trading equity and index options on the floor of the CBOE. I was a market maker there for a long time. And then I moved across the pond to London, where I traded bond options for about 5 years, and then moved back to the United States, where I started and ran a market making business that was centered again on the floor of the CBOE that traded index options and VIX options and all kinds of things. So I've been around the market making and the trading business for a very long time. Currently, I work at OCC helping individuals and investors to better understand both the risks and the benefits of exchange traded options through efforts like the webinar that you're watching today on TradeStation. I always include a disclaimer as well. Options involve risk, etc. Any strategies that I discuss also, etc. You know the drill here. Please do not construe this as a recommendation to buy or sell securities. Trademarks you're going to see here are wholly owned by the OCC. You're going to see them used throughout the presentation. Quickly, about OIC. The OIC is the Options Industry Council. It's the educational arm of our parent company, the Options Clearing Corporation. OCC, or the Options Clearing Corporation, is the largest clearing corporation of equity and index exchange traded options in the world. Now, if you trade options in the United States, either on indexes or on equities, somewhere along the line, in the background, OCC touches that option, either through clearing and settlement or through exercise and assignment. It's part of the pipeline that exists behind the scenes to make this market orderly and stable on a daily basis. OCC has cleared north of 12 billion contracts last year in 2024. It's the first time ever that we've crossed the 12 billion threshold. I'll show you that slide in a moment, but OCC is the parent corporation of OIC. OIC is where all of the educational resources are centered. Optionseducation.org is where you can find all of those. And then options at theocc.com is an email address that you can send us actual email questions that we respond to on a daily basis. Make sure you utilize that resource because it's provided to the public free of charge. Both of those services are free of charge. We never charge for any of our services because we're fully funded by the OCC. All right. This is what I promised you, 12 billion contracts last year. As you look at this graph, you can obviously see that cleared volume from 2000 to 2024 has absolutely exploded over the last 24 years. 2008 is a great reference point that I always use. I was standing in the SPX pit, trading options in the indexes, looked up at the end of the year, which was the most volatile thing I had ever seen, and it was 3.7 billion contracts. Contrast that to last year, north of 12 billion contracts. More people are involved. They're more involved on a regular basis. They're in there trading all the time. My job is to make sure that as many of those people who are in there trading understand the leverage that they are trading back and forth. And so my job becomes much more vital as these numbers continue to get bigger and bigger and bigger every year. And I take my job very seriously. So let's get into it and talk about what we're going to talk about here today. The first thing you need to understand when you're talking about synthetic strategies is a concept called put-call parity. Put-call parity is one of those things that when you first walk in, if you're going to be a market maker, the first thing that you get taught is the concept of put-call parity. What that means is that there is a force that keeps the puts and the calls that are on the same strike, that share the same strike. For instance, the 50 call and the 50 put have a relationship that exists between them that is also tied to where the stock is trading. Most of the time when people talk about put-call parity, they talk about it in kind of like a triangular form, and I'll show you that. The reason why is because generally, when you're looking at a screen, calls are on the left, puts are on the right, and the stock price is usually at the top of the screen, which is a natural way that people talk about it as a triangle. Those three things are always related. And if they're out of whack, there's generally speaking a reason for that. We're going to talk about what some of those reasons might be, how to look out for them, and how to think about why they might be priced the way that they are. Because of the force of put call parity, keeping those two things together, you can utilize the calls and the puts that are on the same strike to create what we call synthetic stock positions. Synthetic stock positions are using the puts and the calls to give you the same directional exposure that you would get from buying or selling the stock. Because of that, we call them synthetic long stock, which is using calls and puts on the same strike in one way. And then we also have, guess what? Synthetic short stock, which is using calls and puts on the same strike in the other way. I'm going to give you an example of how both of those work and how you might think about them. We're also going to talk about a risk management framework that you can think about when you're thinking about these actual positions, because like I said, they involve leverage, just like every option position does. So it's important that you understand that. We'll have some time for some Q&A, hopefully at the end. Let's dig right in. Put call parity. What I told you, the first thing that people teach you when you walk in the door as a market maker is that the puts and the calls have a relationship between them. This is called put call parity. It's a concept. It's really not like a rule, but it is a concept within the pricing systems that are out there that describes the relationship between the calls and the puts on the same strike. What that means is that knowing the value of the call, the price of the call, the fair value of the call, maybe the last price it traded, the last print, can imply the actual price of the put if you know the price of the stock. And if you know the last price of the put, a lot of times you can actually imply the price of the call mentally from also knowing where the stock is. It's a way that all three of these things stay in balance with each other. Now, they're not always in balance perfectly. And part of the reason why is because prices of options are interdependent on each other, but they're also really a function of supply and demand. So if someone is coming in and buying a bunch of a very specific call, the supply and demand function that creates that equilibrium price is going to be dynamic. It's going to move up and down based on how many people are buying or how many people are selling and what the actual supply of puts or calls in that situation is in the marketplace. And so the calls and the puts can move independent of each other. But generally speaking, if the stock isn't moving and the calls are moving one direction, the puts are probably going to be moving slightly in the opposite direction to keep that put call parity in line. The calls, the puts on the same strike, and the stock. Now, generally speaking, put call parity is a force that works in the marketplace to keep things tighter bid-ask spreads, not only for individual options, but also for the actual spreads themselves. And theoretically, it works in concert with those forces to minimize pricing irregularities. That's not always the case, but it is the case most of the time. Now, synthetics are what we call these strategies when we utilize the idea of put call parity and use the calls and the puts on the same strike to create an option strategy that actually mimics both the P&L and the risk dynamics of either a long stock position or a short stock position. I'll show you how we do that by using puts and calls in just a moment. But generally speaking, synthetic strategies are just that. They are using one of these three things, puts, calls, and stock, to create one of the other three things. And like I said, when you start as a market maker, the first thing they teach you is that puts are calls and calls are puts. And that sounds confusing at first. But once you understand how these things work, you start to realize that you can take a call and turn it into a put by trading stock against it. And you can take a call and turn it into a put by trading stock against it, and a put into a call, and a call into a put. And that's how this whole thing works. And that's why they stay in balance with each other. Here's an example. Stock's trading 99 bucks. Okay, I want you to center your mind around a $99 stock. Now, let's think about the 100 strike options. The 100 strike call is trading $4, and the 100 strike put is trading $5. When you think about those two things, now I've been a market maker for a very long time. I look at both of those things and the stock, and I just say, okay, it's all in balance. Now, that math comes to me very naturally because I've been looking at it for 25 years in that way. But if you haven't been looking at it that way, you need to break it down and think about what's going on here. If you wanted to buy long deltas, get long this marketplace, you can buy long deltas and sell the put, also creating long deltas, and collect $1. Because remember, the option you're buying, the call, is trading 4. The option you're theoretically selling, the put, is trading 5. The difference between these is $1, but you are crediting your account $1 by buying the $4 option and selling the $5 option. Now, what does that mean as far as the actual position that you're creating? I want you to think about this. If you're selling that put, and don't think about the call for a moment, just think about the put side. If you were to short that put for $5, you are actually synthetically long the stock from 99, because if you were to sell that put and buy that call and get assigned on the short put, you would actually transact in those two options, both at the strike price, 100. You would be buying stock by getting assigned on your short put and theoretically collecting that $1. And the price that you're actually transacting at is 100, the strike price, minus the $1 that you've already put in your account. You are actually buying stock from 99, which, guess what, is where it was trading in the marketplace. Now, also, if you exercise your long call and you have both of these positions on, you are, again, transacting at the strike price, which is 100, but instead of getting long delta from the short put side that you're getting assigned on, you're actually making the decision to exercise your long call and create long stock out of this. You would exercise that call and then transact at the strike price at 100, but again, you would have that $1 of credit in your account already, thus creating a synthetic long position from $99. Again, where's the stock trading? $99. That's why I look at these three things and I say the 100 strike call trading 4, the 100 strike put trading 5, and the stock trading $1 below that strike is all in balance, essentially. Now, we're not building in things like interest or something that's hard to borrow or a dividend. I'll get into those in a moment, but those are all things that you need to have on your radar, especially if you look at something and it doesn't line up like this. We'll talk about that at the end of this presentation, and I'll give you some examples. Put, call parity, and synthetic positions. This is a list, essentially, of all the different synthetic positions you can create by creating it using calls, turning them into puts, or using puts, turning them into calls, all through calls, puts, and stock. Now, when we talk about this, I talk about long stock as 100 deltas. If you're buying 100 shares of stock, you would have 100 deltas in your position. Long calls have positive delta, and long puts have negative delta. Important to remember that when you think about the positions that you would have and how you might create them synthetically. We're going to talk very specifically about long stock and short stock. You'll see how those are created using long calls and short puts for long stock and short calls and long puts for short stock. But that's not the end result of just all of the synthetic positions you can create. Many times you can take a long call position and create it, or a synthetic, if you're looking for a long call position, you can create it by being long puts and long stock. You can also create the P&L of a short call position by being short stock and short puts. It's very, very kind of dynamic, and you can move things around in any kind of way that you want as soon as you start to understand how these things are all related. You can also create long puts by being short stock and long calls, and short puts by being long stock and short calls. If you have questions about this as you dig into it, and I know I said we're only going to talk about really the long stock and short stock positions here. If you have questions about this that you want answered, make sure to send us email questions at options@theocc.com. We can dig into exactly how these things work more in a more granular way when you have questions that exist around the other ones. Let's talk about the simple way that put call parity works. There's a general formula. Again, this doesn't include things like dividends or hard to borrow stocks or changes in interest rates, things like that. But I want you to think about it in a very general way as the call minus the put. Now we're talking about on the same strike price. If you take the price of the call and you subtract the price of the put, that should equal the strike price minus the stock price. That should be in balance. If it doesn't add up in this way and isn't perfectly in balance, there is likely an arbitrage, meaning the calls are trading for an elevated price relative to the puts in the stock, or the opposite is true. The puts are trading elevated relative to the calls in the stock, or their calls are trading depressed relative to puts in stock. You get the idea here. But likely there's an arbitrage or a discount, what I call discount factors that need to be looked at. What are some of the discount factors? Like I said, carry costs, interest rates changing. That can be a huge factor here as to how to look at the price of the call and the put and what interest rate is being implied by the difference between those two options and where the stock is trading over the duration of those options. So if you're looking at a 30-day option that has the same strike, call and put, and it's different by a significant factor than what you think it should be, you need to think about, is there a different risk-free rate that is being implied by these prices? And if so, why? It could be the 30-day option has a different risk-free rate than the 90-day option, which has a different risk-free rate than the 300-day option. The actual interest rate curve has its own curvature to it, and that's going to be reflected in those synthetic strategies that you're going to see between the calls and the puts on those strikes. Dividends, also not a part of this very simple put call parity formula that I put out there. Dividends are going to factor into both the call and the put prices depending on where they are theoretically being paid relative to the duration of that option. The other thing that's not going to be in here is margin costs. Lots of people ask questions about when I'm thinking about the risk-free rate that exists, should I factor in my margin costs? My answer to that question is always, you need to factor in your own margin costs into your actual cost basis analysis for how you're trading. But your margin costs are going to be different than other participants in the marketplace margin costs are. And so that's part of the dynamic framework that exists. That might mean that someone might be financially incentivized to trade a synthetic strategy that you might not think is a good do because their margin costs are different than your margin costs. And so that's where that's going to show up. It's not going to show up in the actual pricing of the options. It's going to show up in whether or not you think it's financially advantageous for you to trade it because you have your own idea of how much your cost basis is relative to your margin structure. Someone else might have a different margin structure in a different account. If they have $100 million in their account, guess what? Their margin is probably going to be cheaper than the person who has $100,000 in the account because they're keeping a bunch of money at the bank. And so margin costs like that vary from trading firm to trading firm and account to account. Don't think that your margin costs should be inside the pricing of the options for everyone. And then, of course, hard to borrow stocks, those things get really interesting. That's all kind of built into the cost of carry most generally. But hard to borrow stocks start to affect things like call and put prices on the same strike, because what you're dealing with is you can create the synthetic delta exposure and then trade the actual stock against that synthetic exposure and create theoretically a delta riskless trade, but there is carry costs involved. And hard to borrow stocks are where you're going to find those carry costs really start to factor into what things like conversions and reversals are priced. And conversions and reversals are really just the difference between where the stock is trading in the actual marketplace and where you can create it with the calls and the puts. Okay, let's talk about long and short stock because that is really where we're starting here. Stock investing alone is limited to two scenarios: long stock and short stock. That's it. If you're long from your buy price. You make money if it goes up and you lose money if it goes down. And if you're short stock, You're short from your sell price, and you make money if it goes down, and you lose money if it goes up. That's not how these option strategies necessarily work. They are synthetic strategies. Let's start with the long synthetic strategy. It's generally created through a combination of a long call and a short put on the same strike. You need to think about long synthetic stock as long delta. What two option trades actually have long delta? Being long calls and being short puts. That's how you create long delta. Now, you can create long call, short put positions on different strikes if you want to, but that's going to create a completely different risk dynamic than having them on the same strike. The same strike, remember what I said when I showed you that arbitrage or that non-arbitrage situation where the puts were trading 5, the calls were trading 4, and the stock was trading $1 under the strike. When you're trading options on the same strike, you're going to transact either by being assigned or exercising on that strike price. So if you get assigned on the 100 put, you're actually being put shares at the strike price at 100. And if you decide to exercise your 100 call, you're actually exercising the right to turn that into long shares from 100. That's why we use the same strike when we're talking about long synthetic stock. For that reason, I want you to remember long calls and short puts on the same strike equal synthetic long stock. That's the basic takeaway from long synthetic stock. Why is that? Both option positions are long delta. And when combined, the long call and the short put, you get essentially the P&L characteristics of a long stock position. The calls look like this from a P&L perspective. This being the actual strike price right here. And this is the price that you pay for them, the actual debit that you create when you buy long calls. Remember, when you're buying options, the most you can lose on them is what you paid for them. And so you have a defined outcome with long optionality that looks like this, with this bend in the curve being the actual strike price. Combine that with a short put that looks very similar, but in the opposite direction. This is the strike price for the short put. Now, keep in mind, these are very generic graphs. And this amplitude here is the most that you can make on a short put position because you're selling optionality. Short puts have unlimited risk to the downside. Long calls have limited risk to the downside. Long calls have unlimited profit potential to the upside, and short puts have limited profit potential to the upside. That's why when you combined both of these, what you get looks an awful lot like long synthetic stock. What you're doing is taking the unlimited profit potential that exists from both parts of these positions, the long calls to the upside and the short puts to the downside, and you are combining them. And thus what you get is not only the actual profit potential from both sides, but you get this limited actual risk and limited profit built into the actual combined position. So remember, long calls plus short puts equals long synthetic stock. Why is this advantageous? Potential advantages of synthetic long stock is that the call premium is offset by the put premium. When you're buying calls, you are debiting that amount from your account, and selling puts, you're crediting that amount to your account. And so thus, many times people will look at this and say, this is a much more effective use of capital rather than buying the actual stock. If you're dealing with a $100 stock, if you're buying stock, you have to pay $10,000 to buy 100 shares of stock. If you want to create a synthetic stock position by being long the calls for 4 and short the puts for 5, and the stock's trading 99, instead of paying $9,900 to buy the stock, you can create a situation in which you are actually getting a credit to have the same theoretical P&L up and down. Now, the reason why this is different is because there's optionality and leverage built into this. And some ways it's good, and some ways it's not good. Because when you're selling options, you're actually selling the rights to someone else. And so you're not going to always control your position on that side of your optionality. If you're short puts, someone else actually owns the right to sell the stock. Now, if you want to be long the stock anyway, then most people will just look at that and say, that's not a big deal because I want to be long the stock anyway. And if that's the case, then a lot of people will look at this and think that it's potentially advantageous to use these options instead of buying the actual stock. Like I said, a lot of times people think about this as a more capital efficient usage relative to outright stock positions. Now, what are the disadvantages of synthetic long stock? The risk that's inherent within the leverage. Like I just talked about, if you have synthetic long stock, remember your long calls, short puts. The short part of the optionality is the part that you do not control. You are incurring the liability to make that contract whole if someone else decides to exercise. The other thing that can be disadvantaged is margin requirements that vary between brokerages. Like I said at the beginning, different people have different margin requirements. And sometimes those can get out of whack relative to this theoretically more efficient capital usage. When you factor in your actual margin requirements, sometimes it doesn't work out quite as well. The other is the possible early assignment of the short put position. Like I said, when you incur the actual liability that exists in short optionality, you do not control that option. Someone else controls it because they're the ones who bought it. The other thing is the potential slippage that exists here. I want you to think about this. When you're entering into a stock position, you send in one buy price and it gets executed and it's one price. You're either filled or you're not filled. When you're dealing with creating synthetic positions, you're dealing with potentially crossing a bid-ask spread on two different options: buying the calls, paying the offer, and selling the puts, selling the bid, and crossing bid-ask spread there. Sometimes people look at that and say, I don't really care. It just builds into the price at which I'm creating the synthetic stock position. And if it's off by 5 cents, then it's off by 5 cents from where I could have bought the stock initially, because of the fact that it creates more capital efficient usage by using the options. And they're willing to take that as a potential of that position. Some people aren't. And if that's the case, then you need to remember trading synthetic stock positions actually includes trading two option positions. All right, let's flip the coin and talk about the other side of this, which is short synthetic stock. As you might imagine, short synthetic stock is the exact opposite of what we just talked about. You are going to create this theoretically through using short calls and long puts on the same strike. Short call plus long put is equal to synthetic short stock. Big difference here is that both open positions are short delta, not long delta like we just talked about. When combined, they are going to mimic the P&L characteristics of short stock, but we call this short synthetic stock. Short calls look like this. When you add short calls and long puts that look like this, what do you get? You get a short synthetic stock position. It's going to P&L very closely to how actual short stock positions are going to actually P&L. Now, in this case, it has a lot of that optionality that's built into it with a synthetic position that you're not necessarily going to see on the short stock position outright. The same thing holds true here. Potential advantages of short synthetic stock are that the put that you're paying for is offset by the call that you're selling. Those two prices are what create that potentially advantageous efficient capital usage situation. Here are the disadvantages of synthetic short stock. The actual leverage that exists here. If you're short calls, you have the same problem that you had being short puts, but in the opposite direction. You don't control that option. What you've done is sold the control to someone else and pocketed the premium for that control. So you've incurred the liability of making that call whole when someone exercises that call. And what that means is that if the stock is rallying and you're short calls, you need to build in the idea that you might get actually assigned on that position. Now, if you're short calls and long puts and you've created a short synthetic stock position, hopefully you've already thought about that being the actual impetus for why you created this thing. But it's important that you understand that the actual optionality doesn't change just because you've got it on short call, long put versus short put, long call. It's just a directional change where the actual liabilities that you've incurred exist in the different direction. When you're short calls and long puts, you have exposure to the upside that's negative. And when you're short puts and long calls, you have exposure to the downside that is negative. Disadvantages here are, again, margin requirements that vary between brokerages, possible early assignment of the short call positions, and again, the potential slippage that exists between those two positions that you might have to cross bid-ask spread versus one position when you're trading stock, and it comes back as one price. One other thing that I think I need to build in here, especially on the side where you're talking about being short calls and long puts, is the idea of dividends and early assignment. American style options are different from European style options. The biggest difference is that they actually have the ability to be exercised at any point during their life cycle. American style options, which are generally equity options in the United States. European style options can only be exercised at the moment of expiry, when they die, right? That's when those options can be exercised. American style options can be exercised at any point in time. If you're long calls, you are actually maintaining the right to exercise that call and create a long stock position. But if you're short calls, you've actually sold that right to someone else. It's important to build this in when you're thinking about dividends, because when you're talking about dividends and stocks, the only person who gets paid a dividend, if, for instance, a stock announces that they're paying a dividend that didn't exist before, are the people who are the actual shareholders on the record date. If you're long calls, you have the ability to exercise your call and turn yourself into a shareholder. If you're short calls, you do not have that ability. You have sold that ability to someone else. And so in a situation of an early exercise and a dividend that all of a sudden appears out of nowhere, you need to pay attention to what that means for your short call position, because someone else might want to exercise that call and get long stock because they would get paid the dividend. Instead of just being long the call, they're turning it into a long stock position before the record date to actually get the dividend that exists there. Also, think about what happens when people announce dividends and you have a call and a put on the same line. Which one of those becomes more valuable and which one becomes less valuable? I think it's pretty kind of like self-explanatory when I explain to you the situation where if you're long the call and you want to receive the dividend, you have to exercise the call and become a shareholder. That option is going to be more valuable than the put side of things by the amount of the dividend. And so you need to remember that, because that's going to change how much that combo, the difference between the call and the put, is going to where that equilibrium exists, because now you've added a whole nother factor into the fact that someone might be able to exercise that call and create a long stock position. All right, let's talk about the risk framework that you need to keep in mind here. Interest rates, hard to borrow stocks are going to change the perceived value of the synthetic stock position that we just talked about relative to where the actual stock is trading. When you hear people say things like the forward vol or the forward price of something, this is what they're talking about. They're talking about what something might be worth in 20 days in price terms, not in terms of like optionality and theoretical decay and things of that nature. They're talking about just like, what does the forward price of a stock look like if you factor in things like earnings and dividends and et cetera, et cetera. Factors like interest rates and hard to borrow stocks are going to change the perceived forward value of the actual synthetic stock and the real stock. That's going to be where that difference is going to show up. And it's going to show up in how the calls and the puts are priced on that strike relative to where the stock is priced. So keep that in mind. While these do actually look an awful lot P&L wise like long or short stock positions, they involve leverage. They are options positions. Remember what long optionality and short optionality actually means when you're creating a synthetic stock position, because being long calls is different than being short puts. But when you combine them together, you get this kind of, the parts of their P&L curves that look like long stock positions start to combine, and they look an awful lot like long stock from a P&L perspective, but there's leverage in there, and make sure you understand how that leverage works. The other thing is puts and calls are going to have daily mark-to-market prices. There's going to be, just like when you enter into this position, you're crossing bid-ask theoretically on the puts and the calls, you're also going to now have two prices, a put and a call. Most of the time, the put and the call are going to follow the rules of put-call parity, and it's not going to be an issue. But occasionally, puts and calls have differing settlement prices relative to where the stock is trading, and you're going to need to pay attention to that going forward. Sometimes the puts might be off by a certain amount, or the calls might be off by a certain amount relative to where the stock is. Many times that's not going to matter unless you carry puts and calls versus a stock position. And in that case, what you're going to see is that the actual spread between them widens or contracts based on what you have on, and that's going to show up in your P&L. So it's important that you look at that on a daily basis. This obviously can affect margin calculations because your P&L is going to change every day. Only options with the same strike and expiration are truly going to mimic the P&L of stock positions. So like I said at the beginning, you can buy calls and sell puts on different strikes and create kind of a long synthetic stock position that has a very different P&L characteristic than having them on the same strike. If you have them on the same strike, you're going to be transacting at 100 on the 100 call and 100 on the 100 put, regardless of whether you're exercising your long call or being assigned on your short put. But if you move those strikes farther apart, you're going to be actually transacting at the strike price on the put or the strike price on the call that has a very big discrepancy between them. Understand how that works. A few more risk management framework things. Synthetic stock positions include both long and short optionality. Optionality in American style options incurs the risk of early exercise. I cannot stress this enough. If you're doing this in American style equity options, pay attention to things like dividends, to things like changes in interest rates, because people who are long these options maintain the right to exercise them and turn them into either long stock or short stock positions. And remember, someone who is long calls does not get paid a dividend. Someone who is long stock, who used to be long calls and exercise them and turn them into stock before the actual record date, does get paid the dividend. That person is going to likely be paying attention to situations where dividends get announced out of nowhere. And if you're short those calls, you need to pay attention to that as well for the same reason. Long synthetic stock positions are short puts, and short synthetic stock positions are short calls. That's where your short optionality exists on these two positions. Pay attention to that part of your optionality because that's the part you don't control. Now, carrying synthetic positions into expiration is going to incur the same risks that expiring options positions usually carry. That means you got to pay attention to things like where the stock is, what the Greeks of this position are. Generally speaking, if you're carrying a long call and a short put on the same strike, it's going to create 100 deltas like we talked about before. And so the delta characteristics of that are not quite as important as other situations where you have optionality versus stock. But it's important that you pay attention to the actual expiring optionality as potentially as you get closer and closer to expiration, because those things actually become more delicate and more responsive to underlying price as you get closer to expiration. That includes the risks that are inherent within exercise and assignment, like I've been talking about this whole time, and delta risk at expiration. Potentially, if these synthetic positions that you put on all of a sudden are in the money by a significant amount, you have either a very large call that you're long or short, or a very large put that you're long or short. And the other side of that, the other corresponding call or put, is probably going to be very, very small, relatively speaking. That means that a lot of actual value is built into that call position or that put position as they become in the money options positions. That also means that there's going to be a lot of margin that's associated with them because they're very large positions. You need to think about whether or not you should be continuing to carry those positions relative to what your margin costs are, et cetera, like I talked about before. Okay, that about covers it. Now, what I want to stress here is that what this is a general overview, a very general overview of the actual concept of synthetic short or synthetic long stock built by using calls and puts. There are nuances to this that I mentioned earlier. Things like interest rates, risk-free rate, dividends, hard to borrow stocks, all of those things are built into how these are priced in the real world. I want to introduce the concept and then talk about how this actually shows up when you're looking at it in the real world a little bit more closely. Let's take a look at some of the questions. Let's see what we've got here. You're one-way directional. Karen says you're one-way directional. Karen, I agree with you. You are one-way directional. If you have a long call and a short put position on the same strike, you are indeed one-way directional. But the idea behind this is that these are a substitution for directional strategies like long stock or short stock. And what they are is utilizing the optionality in a way that actually leverages the options to create it in a more less capital intensive way. Suzanne asked, do you have slides available? The answer to that is yes. My slides are always available, especially if you're on LinkedIn. My slides are always available. I post my slides in a PDF form on my LinkedIn page. After I do all of these presentations, you can find me, Mat Cashman, on LinkedIn, or you can send us an email at options@theocc.com and ask for the slides, and we'll send those to you for sure. Let's see what else. Charles says he thinks that I know way too much and present it too fast. I understand, Charles, and I apologize if I was moving too fast. If you want me to explain these concepts a little bit slower, please send us emails at options@theocc.com. I'm happy to go slower for anyone who would like to understand this a little bit better. How do you know if your option is American style? Karen, another great question. Okay, so generally speaking, like I said, American style options are equity options in the United States most of the time. Anytime that you have options on your sheets, there will be some denotation of American or European style that should be built into how your brokerage tells you what your actual positions are. If you have questions about that, you need to reach out to your brokerage and make sure that you get the answer as to what you're trading before you trade them, hopefully. The reason why is because if you think about American style options that have the ability to be exercised early versus European style options that only can be exercised at the moment of expiration, which one of those options do you think is more expensive? Which one are you going to pay more for? Generally speaking, if you have everything else being equal, American style and European style, and you're dealing with they're the same strike, they're the same interest rates, they're the same everything, the American style option is going to be more expensive because think about it, it contains more optionality. There's more potential things that you can do with it between now and the time that it expires. And thus, it's going to have more premium built into it. all things being equal, same strike, same everything, American style options are going to be more expensive than European style options. But most importantly, Karen, reach out to your brokerage firm to make sure that you need to understand whether it's American or European before you trade it. Let's see. I've noticed that having stop losses on options tends to get hit only on the turn back around later. What risk management considerations may we have in these synthetic stock positions? That's interesting, Frank. Frank asked that question. Stop losses on options tend to get hit only on the turnarounds. There is one thing that you could theoretically, I can think of that theoretically people might use in that situation. One part of this is because you have two different positions here, really, right? If you're looking to create a long synthetic stock position, you're going to have long calls and short puts. You don't necessarily have to enter into that position at the exact same time. You don't have to buy calls and sell puts at the exact moment. And so sometimes people will utilize the actual movement in the stock to take advantage of that movement. How do I mean? Let's say you walk in and you have an idea that you want to be long a synthetic stock position, and the stock is down 5%. You might use that as an opportunity to actually buy the calls that you were looking at. Let's say you wanted to be long synthetic stock from 100, and you walk in and the stock is trading 90 all of a sudden, whereas it was trading, 100 yesterday. Sometimes people will use that opportunity to actually buy the 100 calls. That means that what you've done is you've entered into the position that you wanted to begin with at a theoretically much lower premium rate. The 100 calls with the stock trading 90 are going to be much less expensive than the 100 calls with the stock trading 100. And then with the idea that you might actually wait until the stock goes up to 100 when the calls and the puts actually start to regulate back to that level that they were previously, and then maybe you sell the 100 puts at that point, and what you've done is what we call leg into a synthetic stock position. When I say leg into something, that means that you potentially have an option position that has two pieces, but that you don't necessarily trade both pieces at exactly the same time. You utilize the actual movement of the underlying to trade one of the sides when it's price advantageous to trade that side, and then you wait for the stock to theoretically come back and sell puts at that point in time. And so sometimes you can use that to your advantage because, and that's really just a function of the fact that you have two different positions here. You have long calls and short puts. You can choose to trade these however you want. My job here is to teach you how they interact with each other and the actual basics of the optionality behind them. And then you can utilize that education to, put it into practice when you think it lines up with your risk exposure. Let's see. On a synthetic long, is your margin requirement the same as on a short put? That's a very good question, Brad. Anytime that people ask questions about margin requirements, I always point them towards their brokerage firm because that's not fully fungible across the entire industry. Margin requirements are different for different brokerage firms and for different accounts within the brokerage firm, depending on your relationship with your trading firm. So you need to ask them because they're going to have the most correct information for your situation. On Schwab, it looks like you can trade a custom two-leg. I'm guessing what you're talking about is creating this as a strategy. It is probably most of the time going to show up as a two-legged spread. Many times it's referred to as a combo. Sometimes people call it a combo, which is long call short put or short call long put on the same strike. And it might show up as a two-leg combo or a two-leg spread in that way. Pay attention to that. For a long synthetic position, are you targeting options at the money or in the money, and how far do you go for expiration? Good question. It depends on how much delta exposure. Well, it doesn't really depend on how much delta exposure you want. Let me give you an example here. At the money options are going to have the most linked. They're going to be closest in premium to each other, so that what you're actually creating here is a synthetic stock position that might create a small credit or a small debit relative to where the stock is trading and the strike. Remember that actual equation that I gave you at the beginning, which is call minus put equals strike minus stock minus strike. Think about that, but also think about the fact that if you want to create these positions, if you trade let's say the stock is trading 100 and you trade the 90 call and the 90 put, what you're doing is creating a synthetic stock position from 90, because that's again where you're going to transact if you actually exercise your call or get assigned on your put. So the 90 strike conversion reversal or the 90 strike actual synthetic stock position is going to trade around $10 when the stock is trading 100, because of the fact that the 90 call is going to theoretically be worth $10 more than the 90 put is going to be. And so when you're actually taking the call minus the put, you're going to see a call that's worth a lot versus a put that's not worth very much. Does that change necessarily your delta exposure? No, but it does change how much you're actually laying out or taking in when you're creating these option spreads. Trading a combo or a synthetic stock position at the money where the call's worth 4 and the put's worth 5 and you're collecting $1, totally different than trading a 90 strike when the stock's trading 100 and the call's worth 10 and the put's worth 20 cents. It's going to be a big difference in how much premium you're either outlaying or taking in. So that's where I would just tell you that you should build that consideration in when you're thinking about that. Okay, I think we've covered many of the questions, Jesus, and we're about 3 minutes away from the hour. So I'm going to hand it back over to you.
That was some great information, Matt. It was really interesting how you can set up these synthetic positions. I've linked an article that we wrote, TradeStation on synthetic options. I'll link to it again here. So if you're looking for additional information on synthetic positions, you can use that article as additional information. So it's there for everyone. So Matt, and other than that, thank you again. These are great presentations. I think we have you scheduled again to be our presenter maybe in a month or two. So we'll see more of Matt's presentation later on down the road. So thank you for that.
Absolutely.
And everyone, thank you. Thank you for being here. Thank you for being part of these webinars, and we appreciate your time. And we look forward to seeing you again. Remember, the Options Education Center at TradeStation is also a way that TradeStation is supporting you by providing you education on all different types of option strategies. So make sure that you visit the link and explore. Thank you for your time. Thank you, Matt, again. Have a wonderful day.
Thanks for having me. It was wonderful. Thanks again. I'll see you soon.
Thank you. Bye-bye.